In this video, we are doing part D of paper 3 for January 2025 SAICA first board exam. Part D requires us to provide the correcting journal entries relating to the loan from BuzzFin for the year ended 30 June 2024. We need to provide a brief explanation for our correcting journal, and we need to ignore all forms of taxation. Now we're going to start looking at the scenario to find out where in the scenario we have information that relates to BuzzFin. If we look at our scenario, 3.2 addresses funding of drones, obviously it coming from BuzzFin. You remember that the plan was that they're going to sell the planes so that they can fund the drones. However, the amount of money for the sale of planes would not be enough for this project. Therefore, they need additional funding from BuzzFin. The amount that will be obtained from BuzzFin is 14 million. Then it will be obtained from 1 January 2024. BuzzFin, just to know about them, they are specialized business financiers. That means they're not actually your general bank like your Nedbank, Capitec, and all other banks, but they are specialized business financiers. We are given the terms. The terms is 14 million, which is similar to what we've been told above. And then we're going to receive an advance on 1 January 2024. There will be initiation fee or transaction fee rather of 0.95%. And then of the loan principal. That means this transaction fee will be 0.25 of the 14 million. Then when you move down, there is PMT. So the installment will be paid every 6 months in arrears for the period of 8 years. So what does that mean? It means for the period of 8 years, we'll make a total of 16 payment, which is 8 times 2. And then the first one will be due on the 30th of June 2024, which will be 6 months later from the advance date. And what is important about 30 June 2024 is the fact that it's our year end and it's the date that we need to process the journals that will be corrected. 30% of the loan principal over the period of 8 years will not be paid. However, it will be converted to variable number of shares. What do we know about variable number of shares? We know that because it's not fixed number of shares, this loan will be converted to, it is not an equity. However, it will be a financial liability. What else that is important is that they will be obtaining 2% of the shareholding in TT. Moreover, we have been provided a nominal interest rate or a market rate. And we are told that it is 11.67%, which is basically your prime plus your risk adjustment for the company. So they have to consider the risk of the company. Therefore, they've added 2.92%. So what do we know about this? We know this is a market rate. It is not an effective interest rate. For our calculation of PMT, we use the effective interest rate. Therefore, we cannot use the nominal interest rate for the purpose of calculating our PMT. Then when we move down, we're going to look at what the accountant has processed. And we know whatever the accountant has processed here, it is incorrect. It is for that the reason we need to provide a correcting journal entries. So what do we see here? We see that there is a bank, and then which means we're going to receive an advance that is 1 January 2024, which is correct. And then it's 13,965,000. We need to say it's 13,965,000. How did they arrive to that? They said 100% minus 0.25 for the initiation fee. They got 99.75. Then they multiply by the 99.75%, 14 million, and they got to 13,965. So basically, the amount we're going to get, it is 14 million minus the percentage that related to initiation fee, which is 0.25%. And then if you move down, they've accounted for loan liability of 11,865,335, and then equity. So what do we know now? We know that this transaction, which is showing equity, is incorrect. It therefore needed to be reversed. Why? Because the number of shares varies. Therefore, the equity cannot be recognized. The full value should be recognized as liability. You see, now, if you didn't understand IFRS 9 properly, you would think this journal is correct. However, it is incorrect on the basis that they have used equity or have credited equity when the number of shares that will be provided to the BuzzFeed varies. So now we've realized that the first thing that we need to do is to reverse this full amount of 2,099,655 and raise a liability, meaning to say we're going to have to recognize the equity that has been raised and then raise a liability. Because then we are showing how did they get all the amounts. And then now we see that they have I. This I is incorrect. Why it is incorrect? Because this is the market rate. We need to use effective interest rate. It is incorrect because this is not an effective interest rate. This is a market rate. We need to use the effective interest rates. Therefore, we need to calculate. Therefore, we will need to calculate effective interest rate. Right. So now we see that what we have, it's not correct. We need to calculate what is correct, which is going to be effective interest rate. Then at year end, which is 6 months later, they are saying interest on loan and then loan liability, then total for bank it's 99500. And they say allocation of payment to interest and loan. If we're looking at the total way the transaction has been processed, it is correct. However, the amounts are not correct. Why they're not correct? Because they've used the market rate instead of effective interest rate in order to calculate the PMT. Now, what we're going to do now, it simply shows that we're going to have to reduce either the interest or the loan liability. Now, let us look at our solution to see how they went about correcting the journal. So if we move and look at what we have here, they started with the calculation of the effective interest rate, and I have provided the reason. It is because the rate that we are provided is market. So we therefore have to calculate the effective interest rate. Now, how did they get the present value? They took 14 million, then they have to reduce the present value by the initiation fee or the transaction fee, which is 0.25%. Now they got the PMT to be 13,965 million, which is similar to what we have on the scenario. And then when you move to N, because they said the payment is done twice a year, that means it's 8 times 2, which makes 16. And PY, it's 2. And then the future value, it's the 30% which we would need to convert into variable number of shares. So the future value will be the 30% that will not be paid and will need to be paid in the form of 2% of TT shares. That will be 4.2 million. And then the PMT we already provided, it's 995. Then we need to compute I. So you're going to use your calculator and compute I. So your I for 6 months will be 3,982 because the PY here used 2. That simply means if you need the yearly rate, you're going to have to multiply the 3.89% times 2, and then you're going to get 7.79%. Now, if you move down, so what are we doing now? We are calculating the PMT. So now what are we going to say? We're going to say we have this 13,965, we multiply by the rate, right? It's going to give 8,893, which means it's going to be 543,937. And then the liability part, which is what we're gonna be reducing on the liability balance, it is 451063. So what do you see here? The first part is the interest that we're going to be paying as a result of having this loan. And the second part is what we're going to reduce the balance of the loan by. So this one, it's an interest. So this is an interest payment. And then the balance that we get, it is actually your loan reduction. So this will be a capital reduction. So we're going to call this one capital reduction. Right. Then you put it here. Then you know that you have capital reduction and the interest. If you add those two, you get this 995 that we have here. Then total payment, it's 995, which agrees with what we've already been provided. The total was correct. However, when it comes to splitting the two, it was not splitted correctly. Now let us look at the journal. When you look at the journal, the first thing that we said we're going to do, we need to correct the financial liability by reversing the equity component previously recognized. In the journal, the financial accountant had processed, they have shown the equity. However, because the shares are not fixed number of shares, we need to reverse that equity. So that our journal will be debit equity and credit liability, meaning to say we are reversing the equity and raising the liability, which was not raised, and it's going to be the same amount. Then you're going to get half a mark, half a mark. And then you also need to explain what are you doing. You are reversing because we should be recognizing the full financial liability as opposed to what have been done. And then the other part is that loan should be measured at initial amount received, which is 14 less 35 million. You would have done here at the top, and then you would have gotten the full mark. The equity component of this loan needed to be reversed, which is generally what you have done here at the top. And then we spoke about the fact that the interest rate that was used, it was not correct in order to calculate the interest payment. For that reason, we're going to have to then reduce the liability because liability reduction was overstated. It should have been 543,937. However, we had 693. No. Yes. The liability was overstated and the interest was understated. For that reason, we have to reduce by 148,405. So we're correcting the interest to be capitalized and the reduction of the loan because the market rate was used instead of using the effective interest rate. And then the rates that we're going to use, it's either 7.79 for yearly or 3.89 for 6 months. So that takes us to the end of this part. Thank you so much for listening to this far. Can you please follow me on my YouTube channel? It's Economics 199. And if you go on TikTok, it's also Economics 199. Please enjoy the rest of your day.